This is Alan Bush with ADMIS. In the stock index futures, there were very sharp gains yesterday afternoon. This after the Fed refraining from curtailing their quantitative easing program, as many analysts had anticipated. In fact, in a poll released just before the Fed meeting, the feeling was that the Fed would taper by either $5 billion or possibly $10 billion, with some analysts expecting even more. And yet the Fed refraining from cutting back on their QE, coming as a big surprise. So big gains yesterday afternoon, some follow-through strength today. So it does look like the quantitative easing program is unlimited. At least that is the way it appears right now. So a very open-ended QE remains supportive to stock index futures. Also, Bernanke really not giving any guidance as to when the QE could possibly come to an end as far as the previous parameters that were stated as far as employment levels and inflation levels are concerned. So all of this support from the Fed remains very bullish, and we cannot expect a top anytime soon in stock indices with so much Fed accommodation. Over to currencies, the dollar index trading at a 7-month low. This directly linked to the Fed's policy statement yesterday, refraining from cutting back on QE. So from an interest rate differential point of view, the dollar under pressure, and that is something that is likely to persist for a while. Also, we had the yen trading sharply lower today. In fact, the yen is the biggest mover of all the currencies, with declines today linked to comments from a Bank of Japan policymaker indicating that there is a possibility that the Bank of Japan could expand their very large quantitative easing program. So the yen undermined from an interest rate differential point of view. Also, we are seeing some pressure in the pound. This after UK retail sales coming in a bit weaker than expected. In fact, they were looking for an increase, and we actually did see a decrease in UK retail sales. However, the clearest indications as far as direction continue to come in the treasuries. Although we did see good gains yesterday on the Fed statement, a lot of these gains are being given back today. Also, in spite of all of the quantitative easing that we have seen, the 30-year Treasury bond has traded lower since July of last year. So we are ignoring basically some bullish fundamental news from the Fed with this downtrend in treasuries. So from here, I would expect lower prices. In spite of the gains we had yesterday, still feel the main trend is lower. Also, there is that double bottom a bit lower in the 30-year Treasury bond that I think we will take out. So if there's any market I think to trade rather aggressively, I think it is the Treasuries from the short side on rallies. Once again, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.